Good morning. Welcome to ORCL Insights. Today is Friday the 13th. Before the market open, we haven't had the CPI data just yet. We're going to talk about that in a second. But one observation I've made is that it has been a very tough couple of weeks in the markets for risk assets, especially for software, crypto, and growth equities. And what I have observed is that back in late September, beginning of October last year, everyone on social media was posting screenshots of their portfolio. Everyone was up 50% every month and 6 or 7 figures in their P&L year to date. Fast forward to today, not only are people not sharing their P&L or portfolio screenshots, they started to call each other names much more often, much more aggressively. You can see there's a lot of anxiety and fear just by the way people communicate and their activities. And I would say that the social media sentiment is probably a great inverse indicator. So if you start taking some profits when everyone screenshots and start buying back in when everyone starts swearing, that's probably a good contrarian strategy against retail. I'm just going to leave that out there, something I've observed. And now we're going to get onto the non-farm payrolls. Looking at the latest non-farm payrolls data, we had a blockbuster month in January, which is something probably the market didn't quite expect because we had higher jobless claims and worse private payrolls numbers the week before. So this did come in as a bit of a surprise. But what I would say is that given the government shutdown, the unreliability of the initial response by the employers for those payroll numbers and the winter storm, I lean towards a high likelihood that this number will get revised down the line. And this has happened numerous times before. So before the payrolls data came out, I did say we should fade the initial reaction, whether it's really positive or extremely negative. And what the market did is that equities initially shot up, but sold off aggressively after the open. I think incrementally, this gives less justification for the Fed to cut rates very soon because the labor market concerns, which they had, now does actually seem to stabilize. So it will be interesting to see what Kevin Walsh does once he comes in, because on the surface, he's a hawk, given his past speeches, but there's no way in this world Trump would appoint Kevin Walsh if he were actually a real hawk. And since the announcement, Trump has actually said numerous times that the Fed should slash rates to 1% or even 0% to help the Treasury reduce interest rates and bring the budget deficit back down. And there has been talks about a coordinated effort between the Fed and the Treasury, a Fed-Treasury accord, where the Fed also takes the Treasury's budget bill issuances into consideration for its interest rate decisions. So I think the new Fed would incrementally be as dovish, if not more dovish, than Powell's Fed. But ultimately, there are still 4 months until the new chairman steps in. So for now, we just have to go with the flow of what the current Fed is watching. Looking at the CPI estimates, the street is expecting a year-on-year increase of 2.5% in the headline data, as well as the core CPI data. My only concern for today is that oil prices in January did shoot up compared to December because of the US-Iran tensions. So incrementally, that could have had a big positive impact on the CPI levels. We will see. But it is a volatile factor. So food and energy are actually excluded in the core CPI reading, which is why we have the core CPI. So the street may not actually focus on the oil component that much. But it is something to bear in mind because a sustained high oil prices will lead to higher inflation expectation, which will lead to higher yields, and that puts pressure on QQQ, growth equities, as well as crypto. Looking at yesterday's market returns, pretty much all risk assets sold off, and even gold sold off by 3%. So this is quite a big sell-off for gold as well. S&P 500 down almost 2%, Russell 2000 down 2.5%, Bitcoin down 4%, gold down almost 3%, oil also down 2%. But like I said just now, low oil prices relieves the pressure on yields, and there has been a flight to bonds as a hedge regime going on because of the recent sell-off in gold. Investors are shying away from gold at times of uncertainty more than before now. And you can tell that from the flipped correlation between gold and stocks. So they are leaning a bit more positively correlating now than neutrally or negatively as before. So this is a very risk-off tape, as you can see. Similarly, for the Max 7s and the crypto stocks we cover, they all fell except for Google and Microsoft, which you can read as more or less flat given the tape during the day. This macro surface is something I've built recently, and we look at the cross-asset regimes in 3 buckets. So risk sentiment, so how well equities, credit, crypto behave versus volatility measures. Liquidity, this includes bonds, credit, but also a negative headwind from a strong dollar or the Japanese yen. So high Japanese yen increases the carry trade unwind risk. And so that's negative for liquidity. And then we have the inflation components where we have both precious metals, which are traditionally seen as the inflation hedge, as well as copper and oil, which are commodities that could drive actual prices, with a negative component for bonds, because high inflation increases the yields, which reduces the bond prices. And where we are yesterday is that we had a very sharp fall in the risk sentiment. So minus 1.4 cent deviations from its 1-year average. A slight positive upturn in liquidity as the long-end yields start falling, and also inflation measures went down because precious metals, commodity all went down while bonds rallied. So overall, I think this is a very defensive posture by the market. So essentially, you can just read this as being defensive and risk-off, with a positive hope that there will be greater liquidity to rescue and reverse the market move downturn. And we have been tracking the US Treasury general account very closely. It is still above 900 billion, which has sucked liquidity away from the market since mid-January. It has stayed at a pretty high level, so nearly approaching 1 trillion the week before. So at the moment, looking at this chart, I'm a bit cautious that I don't think the market can rally hard straight away, or make a sustained move higher unless TGA starts coming down, as you saw at the beginning of January or in mid-December. So we really want this to start turning down instead of staying and plateauing at the $900 billion mark. Also, the Fed funds yields went up after the non-farm payrolls as the market starts pushing out the timing of the first cut. As you can see that in June, we are expecting an 80% chance of a cut, but not 100% chance. And the market is really saying that the first cut will arrive before July, which is still 5 months away. The positive thing is that the yield curve has flattened slightly over the past week. So the 1 year and 2 year yields have stayed relatively flat because the rate cut expectations have been dialed back, but the long end yield have fallen by 10, 11 basis points. So if this keeps going down, that will be a positive for long duration risk assets, for example, technology, crypto, growth stocks. And looking at the ETF flows for the past week, so we are seeing SDOW, which is the short Dow Jones ETF, seeing a lot of traction. It's the number one inflow. We're seeing DUST, which is the bearish gold miners ETF, also attracting a lot of inflow. So people like to short gold here. People also buying IGV, which is the software ETF, up 28%. A lot of it apparently is driven by popular retail demand. So this could be the start of a reversal where we have to be a little bit patient. XBY, which is biotech, EITX is the 2 times Bitcoin strategy fund. So people are trying to pick the bottom here. Another thing that have served us well is the SPY realized volatility indicator that I have built. So this is a rolling 21-day volatility. You can see that during the carry trade unwind in August 2024, and then the tariff sell-off in April 2025, we had sharp spikes in volatility. So this is not the same as VIX because this is the actual realized volatility that's happened in the market, whereas VIX is option pricing. So it's more of an expectation of what happens next month. We still haven't seen a major uptick in the realized volatility in the SP 500. So actually the indices have held up incredibly well, given the bearish sentiment that we've seen in smaller cap growth stocks and crypto. Another thing I have tracked closely is the corporate credit. So the high yield credit blew out in March, April last year, which signaled a dramatic downturn in equities. Whereas for now, we have seen a small climb from the recent levels. So for sure, it's higher than we were in January and December, but it's not a blowout. So it doesn't signal that risk appetite has reduced meaningfully from the past couple of months. So for now, I still lean towards a consolidation narrative in the in SPY. And I think there's a lot of risk unwinding in the high beta sector, and that could just be limited to those. So in contrast, the same chart for Bitcoin, what's interesting is that the realized volatility hit more than 5 standard deviations from its 1 year average. So this is not a level I've seen in the recent years. In fact, I went back and have just not seen this level of volatility. So there is something about this particular sell-off that is way more panicky and aggressive than what we observed in the past sell-offs. But the good thing is every time we reach this level of extreme volatility, the market tends to bottom, at least in the interim, as you can see in March, April over here. So we did start leveling off and bottoming soon after. So at this level, the selling pressure is probably not going to be strong enough to push for significantly lower lows. So yes, we can get a lower low like we did in April, but it does look like the great majority of the sell-off is probably done here. So one more thing I want to look at before we get on to the equity charts is dollar yen. So the dollar yen is a great indicator of the carry trade unwind risk. So a lower dollar yen is bearish for risk because a strong yen increases the repatriation risk of flows from abroad back into Japan. And we really want to see dollar yen moving back higher towards the 160 level. So this level of sell-off since the snap election has coincided with the market going down further this week. So we do really want to see one more high here and reversing nicely upwards to relieve that carry trade unwind risk. So VIX, it has spiked, but it's not above the last Thursday level. And for now, I'm a bit neutral because, of course, it's elevated. We haven't seen a blowout as we did in November, but even back in October, November, SPY didn't actually fall that hard. I think it went down 5 to 7%. And it's just, this is just more of an expression of the anxiety in the market, people looking for downside protections, as you can also see in the put-call ratio and the volatility surface. But the actual, if you look at SPY's actual chart, we're not even 3% off the highs. And the fear and greed indicator is already in the fear zone. So everything in combination suggests to me that we are in a similar phase in this October-November sell-off, where equities consolidated, went down slightly, but under the surface, all of the high beta stocks lost 50% of their value. And there was a great rotation going on. People were chasing the metals trade instead. So this could be another episode of that. Late February is a seasonally weak period. So last year's sell-off started in late February. I still reserve some caution. I don't rule out that we could go lower and retest this VWAP here since June, or even the 200-day. But that is not quite my base case scenario. So my base case scenario is we will consolidate sideways, let the rotation play out between the metals, crypto, software, and high beta names, and we can climb higher into March. Looking at QQQ, so I did expect this pullback to at least be a wave 2 pullback, getting ready for the final waves of this high degree wave 3. But of course, you could argue that there's a chance that this is an ABC sell-off to really complete this wave 4 at a lower low near the 200-day mark. So that is a possibility. And breaking below this VWAP will be the tell that, okay, this will be coming. So I think the risk reward is still pretty attractive for gunning for this wave 3 target here around 650. But if we get below this wave 2 low from last week, we can stop out and just see if we can push for a lower dip buying opportunity at the 200-day. Similarly, for IWM, I did expect a slight pullback for this wave 2. So my base case is that we are going to be grinding our way up towards this wave 3 target near 290. It could get quite choppy in the near term, so I wouldn't focus too much on this timeline per se, but just the price levels. There's a lot of consolidation going on in this area. But failing the 50-day moving average and this wave too low, the next support zone is around 245. So I would probably stop out over here at 255 if forced below, and then look for a re-entry around 245 and see how those broader structure would play out. Stocks, semis. Another clue I would like to follow is how strong semis have been, because there's a lot of focus on the AI narrative where the AI trade is a bubble, is going to be over. And actually, a lot of the damage was done on the downstream software sector, whereas the chips, the semiconductor sector, have held up remarkably well. So we only made a new all-time high in the morning on Thursday before a slight pullback. So to me, the overall trend is still moving higher. We could get a slightly deeper wave 2 pullback and meeting this 50-day moving average for support. But I do think the medium term we're moving higher for the 5 waves. And if you think about how much money the Mag 7s are spending, the likes of Microsoft, Meta, Google, and Amazon on the CapEx this year, they almost doubled the level of 2025. The major beneficiaries will still be the semiconductor companies like NVDA and AMD. So it doesn't strike to me logical that semis will be killed off imminently. IGVs, the software sector, so we're seeing a heavy inflow into the ETF in the past week. And we are battling this VWAP from the beginning of this bull market. So this is all the way from the beginning. This is a pretty important zone because it has been tested several times and held. And the overall shape of this structure is that I think we are in an ending diagonal, so the end of a larger cycle for software, which is why you begin to see a lot of volatility and wide-ranging price movements, because at this moment in time, the market is in a huge disagreement on the value of the software companies given the AI narrative. So we're seeing an expanded ending diagonal here, where all 5 waves consist of 3 subwaves, A, B, C, and we are testing this B wave here. And if we hold here, wave C could be back towards 122 to 136. This wave B has been pretty steep, which caps the upside for this wave C. If we break below this April 2025 low, which is almost unthinkable at this moment, we have so much volume trading at this turning point. But if we break below this, then this structure, I really have to rethink about how this structure is playing out, and maybe this read is wrong. Looking at the 30-year yield, our expectation played out pretty perfectly here. We suspect this would be a topping pattern with head and shoulders. And the confirmation was a break below the 200-day moving average, and now we're moving towards this wave 3 target at 470. So this was all highlighted in the previous weeks and in my daily briefing. This is really good news for market liquidity because lower yields and higher prices support the collateral value of treasuries. It also reduces the discount you have on the terminal values of the future cash flows of growth equities. So the net present values are a bit higher. So we really want to see this 5 waves to really play out for the initial leg of the larger downtrend. And again, TLT has played out, seeing a positive breakaway from this wave 1 high, as well as the trend line resistance from October 2025. And now we're marching towards our wave 3 target, which is in the high $89 zone. Looking at oil, so up to yesterday, I did think one more high was possible. this wave C was not extremely extended relative to this wave A. And the fact that we are still within this range of below the high and above this Feb 2 low. So we are actually still in a neutral area where this one more high is still actually quite possible. But if it starts turning below this February 2nd low, I think, and moving back towards 72 area, I think we're probably safe to remove this warning. So Bitcoin hasn't had a follow through from last Friday and has been retracing since, but it's not been a dramatic pullback from last Friday's rally. So there's not actually a lot to talk about here. We just need to watch for the price to consolidate near here. I'm looking for a near-term bounce towards 85K. And I think the real resistance will come around this 85K to 90K region. Very similar for Ether. So this is the Coinbase exchange. So the volume is based on the Coinbase volumes, but you can see that we are seeing really heightened volume profile from last Friday's rally. So there are people who are starting to buy at these levels despite the sentiment we see online. But the real first test will come from the 2,500 region. There's a high volume profile here, as well as the 50 moving average, which will come down to this area too by the time we reach there. So for now, just gotta watch how the price unfolds and if we can start challenging this region next. Solana, very similar chart to ETH, extremely high volume. Last Friday is starting to pull back, but nothing dramatic. We just want to see how it challenges this particular region at around 120 above. Same for XRP. The real resistance will come from the 50-day moving average first, but then the $2 mark. Coinbase has fallen by nearly 70% since this July high. And unlike Bitcoin, it actually didn't make a new high in October. I think this degree of sell-off was the largest we have seen since the recovery run in January 2023. So because every time it tends to go up 150%, 200%, and it sells off something like 40%, 50%. So over here at 70% is actually pretty extreme. And you can see that from the RSI level as well. It went down to 15. We're testing this region, which also seems to be breaking in terms of a previously tested support zone. And they just had the earnings report last night. They missed the revenue target. The revenue was down year on year because of the lack of crypto trading volumes. But out of the earnings, pessimism was already really priced in. It sell-off, it even sold off after Robinhood's earnings. So it's almost like the market front ran the report. And you can see here, overnight changes were very minimal. So it does look like we could have potentially exhausted the selling over here. So I want to see a nice bounce back towards 200. And this area here around 220 will be where a lot of people started to offload because they thought they were buying the bottom here, but it didn't quite work out with the crypto unwind at the end of January. Robinhood also sold off pretty aggressively after earnings. They missed the earnings expectation as well. So it's down 54% since this high. Falling below this region, the next high volume area is around 62, and after that it's 48. That would be pretty horrific to see because that would bring the drawdown all the way to 67%, which is like Coinbase. What Robinhood is trying to do at the moment is really diversify its revenue streams away from crypto trading, but into two key new markets. The first one is the prediction market, which is getting pretty hot. because you can literally bet on anything. And the second one is tokenized trading. So you can tokenize, for example, the Apple stock and trade 24/7 rather than being limited to the market hours. These two are the big areas that Robinhood is focusing on, and they're really strong believer of using crypto technology for other financial activities, not just the cryptocurrencies themselves. And over time, that diversification should help Robinhood decouple from the crypto cycles. Strategy has actually held up pretty well since Friday's bounce. And it seems to be leading the crypto world at the moment. The first hurdle really would be clearing this 160, so 150 to 160 region at the 50-day moving average. I think MNAV is now trading at 1.2, so there is still demand from investors who are willing to pay above the spot Bitcoin level, because strategy is seen as more of a leverage vehicle due to the convexity of its prices on the way up. There is a great amount of debate on whether Michael Saylor is an absolute genius or an idiot gambler who's just going to gamble away all the investor money, like back in the dot-com bubble. And so far, the sentiment leans towards the latter, that he's a fraud, he doesn't know what he's doing, etc., and strategy is going bankrupt soon. But I've spent a long time actually listening to his talks, his conversations, and his interviews, and the backstory of how strategy got to today. And actually, I'm probably in the minority camp to thinking that he is, or he was at least, ahead of his time, and he knows what he's doing. I actually am quite bullish for strategy and Michael Saylor, but at this right moment, he's very much seen in a negative light. As we come to BitMine, as is Tom Lee. So Tom Lee's image has deteriorated greatly since he became the chairman of BitMine, and obviously the stock has tanked a lot since he bought in. However, if you look at today, we are in a red day, but BitMine holds up pretty well. So the investors' price action is telling a slightly different story, which is that they actually quite fancy buying ETH and the narrative by BitMine. And the advantages of using BitMine is actually, or a DAT like Sharplink will come to in a second, is that they will stake the ETH for you. So they make income, which is about 6-7%. It can be as high as 10%, depending how technical you get to with the liquidity provision. But also the moonshot project that he invests in, like Beast Industries, which are not strictly related to stacking crypto, but someone like Mr. Beast can help the younger generation understand crypto and essentially bring the crypto platforms to them. Right now, the sentiment is very, very bearish on the DATs, but I do see the value that they can provide, especially for traditional investors who don't really want to keep their private keys and open up new accounts on Coinbase, etc. SBET basically following ETH right now. So the 9 mark will be an important resistance for breakout. It's trading at about 16 to 17% below its NAV. So you can think of buying ETH around 1,500, assuming at some point the MNAV will go back to 1. Gold sold off alongside silver as well. And what I did think was that this was a wave B rally. and it could have reached 475. I mean, it still can. That's yet to be seen. But this rally doesn't seem to have that much momentum. And I do think this parabolic top could be the top for a while, as we consolidate over here. And I think, yes, there are narratives of emerging market central banks buying gold, for example, China, but I don't think they are price indiscriminate. So them buying gold at $2,500 dollars per ounce a couple of years ago is very different to buying it at 5,000. Just because everyone else know they are going to buy, they also don't want the market that gets front run. And I do think the gold market, the commodities market, and the crypto market start to see interlinks, because there are multi-strat pods that are leveraged in both precious metals and high beta stocks and crypto. And when gold and silver sell off, they have to dial back the risk and start unwinding positions in software and crypto as well. And that's why you see a correlated move together on the downturn. So to what extent does this still exist today? That's probably quite unclear, because this sell-off at the end of last month did make a huge damage on crypto already. So it remains to be seen whether the further correction will also impact crypto the same way. GDX, very similar. This could be a wave B bounce, and we're looking at lower low in the wave C. Silver. So our signal actually turned risk off for silver and silver miners just before today's dump. I did lean towards probably a bigger bounce in this wave B, but it doesn't seem to be giving us that. If we break below this low here at 65, we're looking at a deeper retrace in this wave 4 that could test the 200-day moving average. And it's a similar story for silver miners. You can see that a shallow wave for pullback, given this length of this wave 3, would put it below 78. So there's still a lot of room down there. Palladium, this could be argued as 1, 2, 3, 4, 5 wave sell-off, and we are probably in wave 5 that could test around 135 or even 140. Platinum's very similar. It could be in 1, 2, 3, 4 wave 5 sell-off that could test the 160s next. Copper, I actually think copper is a bit more bullish. We're in wave 4 retrace. It hasn't even touched the 50-day moving average. So we could consolidate here and make one more high in wave 5. So copper hasn't been as parabolic, and this copper gold ratio has been just a straight way down as well. But that could probably reverse if copper starts climbing higher and gold consolidates. Uranium, it actually has managed to hold above the February 5th low. So we could be starting on wave 5 here. If we do have wave 5, we're looking at this region here in the high 60s and low 70s for the target. BCI did test below the 23% retrace of this wave 3, which is actually sufficient for a wave 4. But given the lack of momentum on the bounce, there is a risk of retesting the 50-day moving average or lower. So I would say this is the target zone for wave 4 between 20 and 21. So Apple is not an easy read at the moment because this rally could be an ABC wave rally, which implies there will be one more leg down, at least testing the 200-day moving average. And in fact, that was my initial position. But over here at 280, it did move beyond, just slightly beyond this wave C standard target zone, which could make it a wave 3. And this would be a overlapping wave 1 with a wave 4, just slightly. And that could be the leading diagonal for the initial wave up. So For now, I'm quite neutral. I want to see the bounce to validate my bullish thesis. But if we fall below here, I think then, yeah, definitely this is the ABC, and we're looking at a lower low in this wave 2. Amazon is actually a bit clearer. We are in 5 waves down, which was my initial expectation after this sell-off on earnings. And now wave 5 could challenge 190, the low 190s. All things considered, Google is actually pretty big. Even the RSI is now approaching the low 30s. We're actually still holding above this February 5th low here. So what I would say is the risk of topping is pretty high. So we're below the 50-day moving average. Valuation is very stretched compared to its 3-year median. And we are liking this 5 wave down, but I will not be shorting it here because this name has shown very strong relative strength, being very resilient in this consolidation pattern. And I would probably lean more aggressively bearish once we break below this 307 or actually 305 region, where there's actually not much volume here for support. And we could be eyeing 275 for this wave 3. Meta, a little bit like Apple, pretty confusing at the moment. So this could be in waves ABC, which is a bearish read because that implies one more leg lower on the downside. But this wave 3 was pretty big after earnings. So this strength gave us a potential wave 3 here, and wave 4 obviously now overlaps wave 1. So that could still be in leading diagonal like this, where wave 5 could reasonably be trading in the high 700s. What we see is that recently Bill Ackman also bought in at the end of last year, so probably around this mark. And people were quite excited for Meta because of it. One thing Bill Ackman cited was that valuation is at multi-year lows. That could be true over here, but right now, both our last 12 months PE and next 12-month PE are around the median mark. So the valuation is not actually that cheap. It's not expensive, but it's not that cheap either. So we're basically in a very neutral region over here, both technically and in terms of valuation. So to validate this wave 5, we really want to see the price moving above the 200-day moving average again. So Microsoft, I actually lean towards this for being stretched now. Valuation is at a Z score of -2, so very stretched on the downside. I would say that near term, I'm looking for at least a bounce towards the 460 region, this 50-day moving average. And this could be a corrective wave still into the 500 region, because this is a 5-wave sell-off, and then that makes it the main trend, and the next bounce is usually corrective. NVIDIA, so ignore the wave count for the moment. You can just basically tell that this name is basically moving pretty much sideways in this 170 to 200 region. So it doesn't really like moving above 195, but it also doesn't like falling below 170. So until one of those areas gets broken, so if we have a breakout to the upside, we're probably looking at the start of wave 5. But if we have a breakout in the downside, then this is a wave C of this wave 4. Tesla, so Tesla has been mostly in a downward channel. This is a very hard resistance zone given the volume profile as well as the 50-day moving average over here. I still lean towards a slightly bearish path of Tesla moving towards 370s to complete this wave C. And so far, I haven't seen evidence against this bearish hypothesis. To invalidate the bearish read, we really need Tesla moving above at the 450 level to put this at the bottom, and we can probably look at one more wave higher after that. So Palantir, this was an obvious head and shoulders pattern we've been tracking. Interestingly, Michael Barry, the big short legend, is also putting out technical analysis on PLTR, which means we're all doomed. He's coming after our jobs. So AI is stealing our jobs. Michael Barry is also stealing our jobs. What are we going to do? That aside, I do think we're reaching the lower side of our wave 5 target. I mean, it could go down to this bottom region here at 125, but I do think we should see at least a bounce in the near term and try to challenge this 180 region. Next, Oracle is just in a really well-defined downtrend. It's spending 80% of its revenue on capex, and its debt insurance, the CDSs, have been going up for a while. Investors quite worried about its bankruptcy risk. So from a technical perspective, it really needs to break out here and actually challenge 200 and get above 200 to put a low as confirmation of this low. APP down 20% after earnings. I did expect this given the 5-week structure we're seeing, and I did think that wave 5 could end around 300. So this hasn't come as a surprise. The near-term path of least resistance will be coming lower and breaking below this trend line. CrowdStrike, unfortunately, I don't have a solid count here. It's been a bit harder to read. But what I have found the most useful is this VWAP from the August 2024 low. So August 2024 was right after it had the bug that affected millions of computers worldwide. And since then, it has managed to make new all-time highs 3 times. And this VWAP has provided pretty solid support for the drawdown. And it has been the case here. So I am looking for a reversal from here and back towards the all-time high. I do think the AI narrative on software stocks generally is overblown, but if anything, cybersecurity will be much more important in a world where billions of AI agents crawl through the internet and talk to each other. Cloudflare, it had an earnings pop, but then sold off after. So we're back to pre-earnings levels, more or less. It does look like a wave C still, because we couldn't get past this wave B high. And this wave C could land around 130 to 140. And this is where we previously had a gap over here, the breakaway gap back in May 2025. And that was the decisive moment when the bullish trend became. Broadcom, it got stuck below the 50-day moving average and this volume profile here. I still think the path of least resistance is lower towards this wave C low. That could land around 270 here. So I'm still cautious on this name. ASML, I do think we're probably in a consolidation pattern, and it's not that obvious right now because it's not like a very obvious head and shoulders, but this is likely wave B, and we have a retrace here for wave C below 1,200 in this wave 4. If you look at the valuations, ASML is at its 3-year high, very stretched against its median valuation in the recent history. ARM Holdings, it has bounced off nicely away from this wave 2 pullback zone. So we could be starting wave 3, which points towards a target around 330. But of course, that is the big picture. We still need to get above this 140 resistance zone first, 200-day moving average, and then above this trend channel upper bound resistance zone line, and then finally the wave 3 target. AMD, I still lean towards this being a wave C work in progress. I think it can reach 180 to touch the 200 moving average. That would at least fill some of this gap before moving higher in wave 3. He recently had the earnings, not extremely encouraging report. The revenue growth has plateaued, even though mega caps are spending like crazy on AI infrastructure. So it does feel like NVIDIA is still taking the huge lead in the semiconductor demand. So that's it for this week. Thank you for tuning in.